Welcome to the deep dive. Today we're really digging into CoreWeave. It's a name that's popped up a lot recently, mainly because of its stock performance. So our mission here is to work through the source material you've provided us. We'll focus on that stock rally and, what these documents are telling investors.
Exactly. Think of these sources as our only map for this. We're going to pull out the key details, what's behind CoreWeave's run-up, the opportunities, the risks that the material points out, and maybe some potential strategies laid out for investors based strictly on what's in these papers. No outside opinions today.
Okay, let's dive right in then. First things first, the material looks at why this stock rallied so hard recently. What are the main factors identified in the sources?
Yeah, the material highlights a few pretty big drivers. Right at the top, there's a major strategic infrastructure move they made, a really significant data center leasing deal.
Right, I saw that. It's a 15-year lease agreement, and it's with Applied Digital. The sources emphasize this gives CoreWeave, 250 megawatts of capacity right away?
That's it. And importantly, an option for another 150 megawatts later.
Yeah.
Which is huge because, well, in this AI space, getting the actual physical infrastructure, the power, the space, that's a major bottleneck.
Mm-hmm.
The sources even note this deal could mean around $7 billion in revenue for Applied Digital over the life of the lease. Just shows the scale of CoreWeave's commitment here.
Okay, so getting that physical capacity locked down is, step one. What else is driving this, according to the material?
The second big thing is their financial performance. The documents really focus on their first quarter as a public company, so it was exceptionally strong.
Strong is, maybe putting it mildly, the number that jumps out from the sources is a 420% year-over-year revenue increase. Just wow.
Exactly, 420%. That pushed their revenue to $981 million for the quarter. And that kind of, explosive growth is directly linked to the crazy demand for their specific AI-focused cloud services. They're not just growing, it's hyper-growth. And the market noticed.
And that demand isn't just abstract, right? It's coming from real players, which brings up the third factor mentioned, these high-profile partnerships.
Yeah, the material really stresses this. CoreWeave has apparently locked in some massive contracts, big names in AI. The standout one mentioned repeatedly is an $11.9 billion five-year deal with OpenAI.
$11.9 billion over 5 years, just with OpenAI. That's staggering. The sources seem to treat these big deals as more than just money, right? Like validation.
Precisely. It's not just revenue, though obviously that's huge. It provides potentially recurring income streams, gives them long-term visibility, and really boosts their credibility. It shows the major AI players are betting on CoreWeave's specific kind of infrastructure.
Okay. And then there's one more factor the sources touch on, the general market.
Right, just the broader environment. The NASDAQ, the S&P 500 hitting new highs. That general bullishness in tech definitely provides a bit of a tailwind. When the tide is rising, investors tend to look more favorably on these high-growth tech stories, especially in hot areas like AI infrastructure.
So you put together the massive capacity deal, the incredible revenue growth, back it up with huge customer commitments like OpenAI, and then you have this favorable market. It kind of explains the fireworks we saw in the stock price.
According to the source material, yeah. Those factors combine to create this really compelling growth story that investors clearly latched onto.
Okay, but here's where the sources get really interesting, I thought. They lay out the why for the rally and then immediately pivot. They ask the big question. Is CoreWeave too risky to buy now after that huge run-up?
Yeah, and the material doesn't give a simple yes or no. It frames it more like, it depends. Depends heavily on your risk tolerance as an investor and how you might approach it. So let's break down that balance based on what the sources say.
Let's do it. Start with the reasons to buy the opportunity side of the coin.
Okay, reason number one is basically what we just talked about, that explosive growth, that 420% year-over-year revenue jump. The material calls it extremely rare, even for AI infrastructure companies right now. The demand for what they offer, specialized GPU cloud services for AI training, it's just incredibly high. They're benefiting directly from, the NVIDIA supply situation and the whole AI boom.
So they're right in the sweet spot of high demand specialized offering.
Pretty much. Second reason highlighted, those big contracts are secured. That $11.9 billion OpenAI deal comes up again. The sources emphasize it provides recurring revenue potential and that long-term visibility we mentioned. Knowing that kind of money is potentially coming in for 5 years, that adds stability. And that 15-year infrastructure lease, that signals they're committed to scaling up to meet this demand long-term.
Suggests they're not just grabbing short-term opportunities, they're building for the long haul. Okay, what's the third point on the opportunity side?
It's their positioning. They're described as a sort of first mover, or at least an early leader, in a specific niche within the cloud market. The sources are clear. CoreWeave isn't trying to be AWS or Azure, the giant general-purpose hyperscalers.
Right, they're not offering everything under the sun. They're specialized.
Exactly. They focus laser-like on those really demanding AI workloads. Think training large language models, like the ones behind ChatGPT, managing huge clusters of GPUs. This focus lets them optimize their whole setup for that specific task, maybe better than the giants can, giving them an edge in this high-value segment.
Okay, so the bull case is explosive, validated growth in a crucial niche backed by big deals and infrastructure commitments. Makes sense. But the sources immediately counter that with the risks. Let's get into the reasons for caution, the potential downsides.
Yeah, the first big one mentioned is simply valuation. The material makes a big point about the stock running up over 250% in just a few days. That kind of vertical move, the sources say, makes it very likely the stock is significantly overbought, at least in the short term.
Right, and the risk is that the current price might already be baking in perfect execution going forward.
Which is always a dangerous assumption, especially for a company scaling this fast. Any stumble could really hit a stock valued like that. Then there's concentration risk. This is a big one flagged in the material.
Ah, so those big contracts, they cut both ways. Opportunity, but also risk.
Exactly. The sources point out a high dependence on just a few mega contracts. OpenAI is the prime example again. The critical question posed is, what if one of these huge clients cancels or drastically cuts back their spending? That could leave a big hole.
Or what if those hyperscalers, AWS, Azure, or the other competitors mentioned, like Lambda Labs, really step up their game in this specific AI niche and start taking customers?
That reliance on a few customers is definitely presented as a key risk. Another major area flagged is execution and the sheer cost of infrastructure. Building out these specialized data centers, buying all those expensive GPUs, it requires massive upfront capital spending. Huge CapEx.
So they're spending billions now to build capacity they hope to fill later.
Precisely. And the risk detailed in the material is, what if demand cools off unexpectedly? Or what if they hit delays or cost overruns building this stuff out? That could really squeeze their profit margins. It's a very capital-intensive game they're playing, and execution is everything.
Okay, and one more risk mentioned.
Just the nature of it being a newly public stock.
Right. Often means a smaller float, fewer shares actually available for trading.
Exactly. Smaller float, plus often attracting more speculative traders drawn to the hype. It can lead to really wild price swings, up and down. So the sources basically say, if you can't stomach volatility, this might not be the place for you right now.
So it's a picture of huge potential, yes, driven by real growth in deals, but also significant risks tied to that rapid rise, customer concentration, the cost of building it all, and just market volatility itself.
Definitely a high-risk, high-reward situation as laid out in the material.
So given that balancing act, the sources don't just leave it there. They actually suggest some ways investors might approach this, considering both the rally and the risks. What strategies are discussed?
Okay, one approach mentioned is pretty straightforward, but needs patience. Basically, buy the dip. The idea is to wait for the stock to pull back significantly. Maybe down to key technical levels the sources mentioned, like the 10-day or 20-day moving average. These are lines traders watch for support.
And they suggest looking for specific signs if you take that approach, like confirmation.
Yeah, the material mentions watching for trading volume to dry up on the down days, suggesting selling might be exhausted, and then looking for a bounce, ideally with some strength, some volume coming back in. It signals buyers are stepping back in and maybe establishing a floor there. It's about letting the dust settle, not chasing.
Okay, wait for a pullback. What's another option presented?
Option 2 is described as starting small and scaling in.
So don't go all in at once. Maybe take an initial position, like what, 25–30% of what you ultimately want to invest?
Right. And then crucially, you only add more if the stock starts behaving well. Maybe it forms a base, like a flag pattern, or some kind of consolidation the traders look for, patterns that suggest it's digesting the gains, maybe getting ready for another move, rather than just falling apart.
And with this approach, given the volatility, risk management is key, right? The sources mention stop losses.
Absolutely essential, according to the material. Use a stop loss order, set it to automatically sell if the stock drops, say, 10% or 12% below where you bought in. It's about limiting your downside if the trade goes wrong, which is critical with these high flyers.
Makes sense. Protect your capital. What about options? Did the sources get into that?
They did, yeah. For investors who are comfortable with options, the material suggests using them strategically, especially because the stock's volatility is probably really high right now. High implied volatility, or IV.
And high IV changes how options work. What strategies did they mention?
Well, they suggest looking at things like bull call spreads. That's where you buy one call option and sell another call option at a higher price. It limits your maximum profit, but it also limits your maximum loss. So it's a defined risk way to bet on the stock going up.
Okay.
Another one mentioned is put credit spreads. That's suggested if you think the stock will likely stay above a certain support level, you're essentially betting it won't collapse.
And there was a specific warning too, right, about what not to do with options here.
Definitely. The sources strongly advise against buying naked calls, just buying call options by themselves. The big risk there is what's called IV crush. After a huge rally, that implied volatility can plummet, even if the stock price doesn't fall much, or even goes up a bit. That drop in IV can just destroy the value of the call option premium you paid. It can evaporate really fast.
Got it. So use options carefully, focusing on defined risk strategies if you use them at all. The sources also threw out some specific price levels to watch on the chart.
Yeah, technically, focus points. They mention $160 as maybe a psychological resistance level. Round numbers sometimes act as barriers.
And on the downside, support.
A potential support zone is identified between $130 and $135, described as a place where the stock traded sideways for a bit after a previous jump, so maybe buyers would step in there again.
Okay, $135 is potential support, and one lower level mentioned.
Yeah, $120 is noted as a level to watch. The material suggests a break below $120 could signal a risk of a more significant decline.
All right, so wrapping this up, based only on the source material we've walked through, what's the final distilled takeaway?
Well, the sources paint a picture of CoreWeave as, look, one of the most compelling post-IPO stories out there right now in the AI infrastructure space, especially for a growth investor who can handle some significant risk.
And this is a big but from the sources, it's definitely not about just jumping in blindly after that huge run. The emphasis seems to be on recognizing that this huge opportunity comes packaged with equally significant risks: valuation, concentration, execution.
Exactly. So the suggestion is to approach it with discipline. Think about risk-adjusted exposure. Maybe use one of those strategies, buying a dip, scaling in carefully defined risk options, and have clear entry and exit points in mind, maybe informed by those technical levels, while being very aware of the potential downsides.
So based purely on these facts from the source material, here's something for you, the listener, to think about. You have this explosive growth, these massive contracts driving it, but also this enormous need for ongoing investment and the inherent risk that comes with executing perfectly at scale, plus a potentially stretched valuation. How do you weigh that execution risk against the opportunity described here? And how does that calculation influence the way you might think about approaching a stock like this, if at all?
Definitely something to mull over after this deep dive.
Thanks for joining us for the deep dive.
Always good to explore the material.